So Kevin O'Leary, a very smart long-term investor, has came out and admitted that 20% of his small private portfolio will fail. And when he means fail, he means that they're essentially going to go to zero. And if you don't know, Kevin O'Leary is a very smart investor, and he's on the TV show Shark Tank, which I'm probably sure you've heard of. And he invests in many small privately owned companies. And many of his companies are not tech-based companies, and his companies are really getting destroyed right now. So today we're going to talk about why Kevin O'Leary thinks that 20% of his portfolio will fail and how that should affect your investing strategy in 2020. And I'll be sharing my thoughts on his opinion. So the first reason that would come to my mind to explain why Kevin O'Leary thinks that 20% of his portfolio would fail would actually be the coronavirus. But that's not actually the direct reason why 20% of his portfolio will actually fail. The reason is mainly due to a shift in consumer trends which are being exacerbated by the coronavirus. Take the restaurant industry, for example. Many investors, including Kevin O'Leary, were invested in restaurants because they've been stable for so many years. But then DoorDash, Uber Eats, and other food delivery services started to become even more popular, taking away market share from dine-in restaurants. So dine-in restaurants started to lose market share, but due to the whole illness going around, delivery became much more popular and much more favorable option for consumers because people really can't eat in a restaurant. So market share is moving towards businesses which are taking advantage of food delivery services, but it's very difficult for many small businesses to take advantage of these services because larger businesses in the space are much more competitive. And this is part of the reason that Kevin O'Leary thinks that 20% of his portfolio will actually fail. And he has said that he's noticing the same thing happening in many other industries, like with gyms and movie theaters, for example. Instead of paying for the gym, people are just watching videos online and doing their workouts at home. Instead of going to an actual movie theater, people are just watching new movies that are coming out on their phones. And these trends make Kevin O'Leary think that part of his portfolio will actually go to zero. However, if you own any brick and mortar store or any store or stock in general that's not in favor of consumer trends, I don't want you to assume that their stock is automatically going to zero, and here's why. Kevin O'Leary's businesses are very different from your businesses. Kevin O'Leary's small private portfolio is made up of very small companies, and most of them have less than a decade of operations. Subsequently, they don't have a lot of cash sitting on the side, and they have to pay very high interest rates on any loans they want to take out because they're more riskier than larger corporations. And this is going to make it hard for a lot of these businesses to survive because they don't have a lot of cash, and they're probably going to take losses for the rest of the year. It's just going to be very hard for them to make it through. But if you own some big company or some big restaurant like McDonald's, a Cheesecake Factory, or Domino's, they're definitely going to have the cash to make it through this situation because they have so many liquid assets, and they can take out loans at very low interest rates compared to smaller businesses because they're less risky of an investment from the bank's perspective. So the chances of your large stocks going bankrupt are quite slim. But we can't ignore what Kevin O'Leary said about the changing consumer trends. It's not going to be a rosy situation for all these large businesses in the post-pandemic world. Even if a vaccine came out today, a lot of companies are going to have a slow death over the long term. So let me explain what I think might happen in the future. So until the illness came in, the economy was thriving and booming. Small businesses were opening, and small business owners were very happy because they were very profitable. But once the illness started, a lot of brick and mortar store owners became very worried. They were not worried because they had to close their stores due to the lockdown. Instead, they were worried about the post-pandemic world and whether there would be enough demand today so that they could reach their previous levels of profitability. If they didn't get a lot of their customers fairly quickly, a lot of these small business owners would be forced to shut down because they can't sustain losses for a prolonged period of time because these small business owners rely on the income for their small business to pay bills at home. So the government came in with their PPP loans, which allowed these small businesses to get temporary liquidity so that they could keep their doors open. But at the end of the day, consumer demand for brick and mortar stores fell pretty hard. For example, restaurant demand fell by over 70%. So even after the lockdown ended, small businesses were still losing tons and tons of money. And a lot of the PPP loans weren't as helpful as they thought they were going to be because many business owners took them out assuming that they were going to be able to achieve their previous businesses' levels of profitability. And since they could not recover quick enough, many small business owners have been forced to shut down. In fact, Yelp announced that 55% of businesses that initially announced that they were going to temporarily shut down have come out and re-announced that they are going to permanently shut down. And although the illness is really sad and really bad for small businesses who have been forced to shut down, it might not be too bad for large businesses, and here's why. Since there are less small businesses around, it means that the consumers who used to go to those small businesses now have to look for alternative businesses to go to. So a lot of those consumers are now going to shop at larger businesses and larger corporations because they're more well-known and have some level of trust with them. This means that certain large businesses and stocks that you own can see their profits increased over the long term, assuming assuming that the economy and the world returns to normal again. So right now, my number one tip for investing right now would be to invest in companies with very strong products. Looking behind the business is probably one of the most important things when investing. And investing in companies with very strong products is equally as important. If a business has a strong product, consumers are going to flock towards them as other businesses in the same niche are closing down. For example, if a small local donut shop closes in an area, their customers are now going to go to Dunkin' Donuts to have their donut needs fulfilled. So some small businesses closing can actually benefit these larger businesses over the long term. And this is only going to benefit large businesses who have the strongest products within their niche. And that's why it's so important to invest in businesses with such strong products over the long term. And that's it for this video. Make sure to drop a like and subscribe, and I hope you enjoyed this video.